Hello, everyone, and thanks for joining us this month for Side by Side Digital. I'm your host, Rebecca Shively. We've got a great program lined up today. This month, we're talking about managing machinery and equipment investments. We've got a couple special guests on today. Sonia and Lucas are both with AgDirect, and they're going to share some insights and tips around making smart machinery and equipment purchases. We'll also have some time near the end for a Q&A. So again, be sure to submit those questions for us. Sonia, Lucas, thanks so much for being here. I'll turn it over to you, Sonia. Why don't you tell us a little bit more about yourself?
My name's Sonia, and I am an inside rep here at AgDirect on the business development team. I didn't start with a farming background at all, no ag experience. I came into the company never setting foot on a farm or hadn't even seen a tractor up close. But the nice thing about working here at FCSA and AgDirect, we have some pretty incredible teammates. And so they took me under their wing and they got me trained and acclimated pretty quickly. And now I've been here 6 years now. Hopefully I know a thing or two more than when I first started. And I am just really excited to be here and to kind of provide some insight for you guys. I will say, being in sales my whole career, I've worked with a lot of different customer bases. I have never encountered a more honest, hardworking, down-to-earth group of people as farmers. So it has been an absolute pleasure to be in this role and to do what I do. So I'm really excited to be here. And I'm going to pass it on to Lucas so we can get to know Lucas.
Thanks, Sonia. My name is Lucas Scheibe, AgDirect Territory Manager in North Dakota. I've been with the company just under a year, and I come to AgDirect FCSA with just short of a decade of equipment dealership experience. Originally from South Dakota and spent the last 8 years down in Nebraska, an equipment dealership down there in the sales and management side. So grew up on a small farm and moved off the farm. I like to say I'm the first generation off the farm with no opportunity to return. So like you guys, most of us have a special place in our heart for ag and love what we do. So I currently reside in Bismarck, North Dakota with my wife and 2 kids. And I am happy to be here and a part of this panel today. Thank you.
Awesome. Thanks, Lucas. So I thought I'd get us started, just give us a quick background on AgDirect a little bit. So we are the farm machinery and equipment lending arm, financing arm of FCSA. We've been around over 20 plus years. In the last few years, we have partnered up with almost a dozen or so farm credit associations across the United States. And so now our scope is the whole US. We service customers all the way from the West Coast to the East Coast, and we're pretty excited about that. What Lucas and I thought today, we'd break it down. I would share with you kind of on, as an ag lender, what an underwriter or what a lender would be looking at when you apply for financing, what they're looking for and what they're looking at. And Lucas is kind of give you more insight on how to sort of approach purchasing equipment and managing machinery and equipment purchases. So I'm going to just jump right in. Initially, and you guys all know this, like Lucas was saying, I don't want to insult your intelligence. I know you guys know most of this stuff already. Hopefully I'll provide some additional tips on top of what you already know, but we're looking at your credit bureau initially. And I think a lot of times there's a misconception that when we're looking at your credit bureau, we can tell your ability to pay. And that's not what a lender is looking at all. Your credit bureau doesn't show us how much money you have in your bank account or how strong your operation is. What a lender is looking at, it's what we call your propensity to pay in a timely manner. So what are your behavior patterns as a borrower? What are your patterns? Really, what we're trying to see is we're trying to predict what your behavior will be like if we were to lend you money, and see what we want to assess your risk level there. What I thought is I just put on like an underwriter hat, borrow one of their hats, and just like the red flags, like what they see when they look at your credit bureau, the things that pop up to them, the things that cause major automatic declines. Usually, there are 3 or 4 things, and you guys probably already know this: recent bankruptcy, a derogatory public record file like a tax lien collection, or if you are currently past due, and that's huge. I see that a lot. I just actually had an example of that this last week where I had a young farmer who had a charge that he was disputing with, I think it was DirecTV, less than $100. He's disputing that charge. Unfortunately, DirecTV still reported it as currently past due. On that gentleman's credit bureau, he's a young farmer. He had some accounts, not a lot of deep credit history. He paid all of his accounts on time. I tried to take it back and push back on my underwriting team for him. Unfortunately, they're looking for that, your behavior as a borrower, your propensity to pay on time. So that small $83 cost him that baler that he was trying to borrow. I just couldn't get it approved for him. So if you know that there's an outstanding balance out there for you, try and get that cleaned up before you apply. Especially if it's small dollar amounts, it just helps you so much more in the back or when you come to apply. The other thing that they're going to be looking at with collections, what's helpful for me as a salesperson, if you have satisfied that collection or that tax lien, you've paid it, if you provide me with a document that shows, yes, this has been taken care of, this has been satisfied, that is something I can take right away to my underwriter and help get us a favorable decision. The other big red flag, major derogatory, would be severe late payments. And I know Lucas is going to hammer this into you too with late payments, but lenders, creditors, they report to the credit bureau if you're 30, 60, 90 days late, how many times you've been 30, 60, 90 days late, how many accounts you've been late on, and how recent those late payments occurred. That 90-day late payment, it is hard for us to get an approval if an underwriter sees that. A good rule of thumb for you guys is most lenders, what they want to see is that over 90% of your trade lines have never gone delinquent. Some lenders may have a cushion, more of a cushion. Other strict lenders like AgDirect, we kind of want to see you more towards that 100%. But 90% is a pretty good rule of thumb. Pay stuff on time. What's helpful is getting set up on those automatic withdrawals. I know things can get busy during harvest. Don't miss those payments. It is hard for us to kind of turn around decisions or get terms that you want when the underwriter sees those late payments. The other thing that they're going to look at is compare what are called, your depth of credit history is obviously going to be helpful, especially on overturning any sort of late payments. What they love to see, what helps me the most is if on your credit bureau, if there is a comparable trade or multiple comparable trades. And what that means is that there's an installment note similar in size to what you're requesting that you've paid well on for 2 years. They like to see 2 years worth of clean repayment history, especially on those types of notes. A tip for you guys is some lenders, you may come to us and we see limited credit, but you know that you have loans out there. It's because some lenders don't report. There may be local lenders that you work with, that you have installment notes with, that don't report, or there may be captives. I know, for example, John Deere doesn't report. What's helpful for us as a salesperson then is if you were to provide us with 2 years worth of payment history on those notes, just send that over to me. It's something I can take to my underwriter and say, hey, Mr. Underwriter, they have proven that they're able to take on, this much money and that they make their payments on time. And often I can get those overturned. The last, or one of the other things that they're going to look at is your credit card debt. I think with credit card debt, we want to make sure that you have credit cards and that you're paying on your credit cards. Again, we're looking at your propensity to pay. It's showing us what kind of borrower you are. The issue is you don't want to have a lot of outstanding debt, because then that raises your risk level, right? The sweet spot there for most lenders, I would say, is about 40% on your revolving burden, meaning, we don't want you maxing out on your credit lines there. So if you know that you have a lot of credit card debt out there before you apply, to kind of get that sort of cleaned up a little bit is very, very helpful, because that's another big red flag that they look at. Other things that they're going to look at are if you've opened a lot of trade lines recently, that increases your risk. For the underwriter, that red flag pops up, like they're taking on a lot of debt. Are they going to be able to make payments if we extend this loan to them as well? Or if you have a lot of inquiries, a lot of things. If you've applied at a lot of places and they hit your credit, that's also a red flag. Majority of the time, you guys, and I know you guys are young farmers, new farmers, may not have a lot of established credit yet. When I go back to my underwriter to try and get relook options, 99.99% of the time, the relook option they say is, can you see if they can add a strong co-applicant or guarantor? And I know you guys, you want to get established and you want to start, you want to build your credit. This is the best way and the easiest way for you to do that is if you have someone that can sign on with you, either co-app or guarantor, that can provide that depth of credit history, clean repayment on their credit. It gets your foot in the door. And then the next time you apply, it's that much easier to get you approved. If we can't get you approved off of your credit and say, we can't get a co-applicant or the co-applicant's not strong enough, say you have a large dollar amount and, credit bureau co-applicant is just ain't going to cut it. And we need additional information to try to get comfortable with a favorable decision for you. What we're going to ask for is financials. And here, what we're looking for, or we're asking, most lenders are going to ask you for is a market-based balance sheet with full asset and liability schedules, and then income numbers, income statements. A lot of times it's 3 years worth of income statements. We want to see what your income trend has been over the last 3 years. The emphasis here, I talk to customers about this every day, 10 times a day. The emphasis here is on that market-based. A lot of times, I know you guys are busy, you're out in the field, you may not have a lot of time to put together a balance sheet. So you may use accounting software of some kind, maybe QuickBooks, or you work with an accountant and you send in a balance sheet that way. Those types of balance sheets, a lot of times what we see are accrual based that show depreciation. And as a lender, it is very, very difficult for us to get an approval for you using that type of balance sheet that shows depreciation. What we like to see is that market-based. So it gives us a snapshot of what your operation looks like today. Having the values of your assets and liabilities today. Giving us as much detail as possible. So for example, on your machinery and equipment, you list that out and you give what today's value would be on that equipment. On your debt schedule, you're giving us the amount that you owe, how long of a term, and the interest rate. Having these details is absolutely crucial. If you don't have access to a market-based balance sheet, most lenders, for example, here at AgDirect, we're able to send you a balance sheet template that you can fill out. A lot of us salespeople, we love helping you guys out, filling that out too. So it's something that we can work with you over the phone too, have you fill that out and send it in. I can't stress enough, a good quality balance sheet with details, the more up to date it is, the easier it is for us to push back and get approvals and get the decision that you want. And with tax returns, they typically want to see all pages, the income statements, they want to see 3 years worth. What the underwriters are looking at, and most of you guys already know this, but what they're trying to hone in on, and there's a lot of stuff, but the main stuff would be they want to make sure that you have good liquidity, that you have good working capital, that your current assets can cover your liabilities, your current liabilities. The other thing that they want to see is they want to make sure not only are you sound financially today, but that, hey, we're going to lend you out, we're giving you a 6-7 year term. We want to make sure that in 6-7 years, you're able to make those payments as well. So we want to make sure that you're sound financially in the future as well, that you're solvent. And the last thing they're going to look at is your repayment capacity. Obviously, as a lender, we want to know your capacity. So the income that you generate, is it enough to cover your expenses, your living expenses, and your term debt? Those are the main things that we're looking at. And the more detail we have, the easier it is for us to kind of figure out what that would be for you, and get you approved. And
Hey,
so,
Sonia.
yes, yeah.
Hey, so as these guys approach purchases and they're looking at taking out loans with AgDirect, what kind of dollar amounts are you talking where they'll need, a
Yeah.
market-based balance sheet and some of those things?
Great question. So we start to need that when you're applying for 250K or more. We're definitely going to need a balance sheet. If you have a weaker credit bureau, that's another time where we might request a balance sheet. Equipment like titled equipment and say irrigation equipment. A lot of times with equipment like that, there's higher risk. So we're going to want to see it maybe at a lower dollar amount, maybe 150K or above. That's where we're going to want to start to see financials. It's a great question, Lucas. Great question there. That's really what I had. I could go on forever and ever. I was telling these guys I can get pretty long-winded. Again, Lucas and I, we love what we do. We love helping you guys, and seeing 25 people on this webinar is pretty exciting. When you guys are eager and excited and you guys come to us, we get eager and excited as well. And we love helping you guys out. So if not in this chat or in the Q&A, if you want to reach out to someone on the business development team or Lucas or I, we are more than willing to answer any questions that you have. But that's it for me on the lending side. I'm going to throw it over to Lucas and get some more insight from him.
So I'll take a little bit of a different approach to maybe a little bit of what you should be looking at, what impacts purchases, on the machinery and equipment side. And I kind of put my dealership hat back on here. And this isn't necessarily just from a finance or a lending perspective, but a little bit about how does it fit the operation. So I'm pretty simple. I'm a pretty simple-minded guy, so I like to stick with usually 5 factors. So these are the things that I deem as things that should impact purchases, right? So, does it have a sole purpose, or can you utilize the machine on other parts of the operation? For instance, like a combine. If you looked at it from a construction standpoint, if you owned a construction company, would you even own a combine? Probably not, right? But it's a necessity as a farmer or producer, is all of your income is sitting out in the field and you got to get it off. Does the specs work or does it fit your operation? Can you adapt the machine easily for a different season or a different application? Then arguably some folks would say price should be number 1, but it's usually fits into that second or third category. And how do you equate it to cash flow in terms of cost per acre? An example I like to use is how many acres do you need to justify a sprayer payment or a combine payment? What's the economics of that equation in terms of the facts? Obviously everybody wants to run around in new equipment, but how do you attribute a value to having your field sprayed, in a timely fashion, in the correct way versus having the co-op do it? And how do you put a value on that? And can you push the pen to paper and gauge the outcome? And another great example of that is when you upgrade equipment and you go to a larger piece of equipment. What are the downstream effects of adding larger equipment to your operation? Does that equate to more manpower, more trucks, more maintenance, all of that? And then another thing from my dealership days that we like to talk a lot about is the availability of parts and service. The dealership proximity, the support. Is the equipment you're looking to purchase, can you get it serviced and get parts within a reasonable distance from your farm? What kind of resources does your dealer offer? Premium dealer support, with extensive resources, is basically, in today's terms, something that is a key factor in how you can maximize the utilization of that piece of equipment, and also maintain what we like to call equipment availability, right? So not just the fact that the equipment's in your yard, but is it available for use when you need it? So arguably, this is probably one of the most important aspects in the equipment buying process. And then number 5 there, the brand loyalty and resale piece of this. I guess I'd just like to ask the group, is brand loyalty a thing of the past? For a lot of folks, it's rapidly becoming less and less of a thing in the eyes of today's producers. But, running mixed fleets has its advantages, whether it's red or green or yellow or different colors. But it also presents a lot of challenges. For instance, if you've got 3 different colors on the farm, you've got to stock 3 different kinds of parts. So potentially you're going to have 3 different machines running at different times, and one of those goes down, running for parts or services coming from a different direction. So the other aspect of that is learning and understanding those 3 different types of machines, especially if you're not in those machines every single day. That can present a whole new set of challenges. So, and then also technology and competition is also making brand loyalty less of a factor. But again, the secondary market still drives a lot of this, with strong resale numbers for different types of colors of paint, whether it's red or green or blue or what have you. So I guess my advice is ensure you've got those first 4 boxes checked, and you feel comfortable about the direction you're going to go with a purchase before you worry about what kind of equipment that your grandfather ran or the neighbor has. But it's all good to take all that stuff into consideration. So next slide. So next, we'll just look at some buying trends when it comes to machinery and equipment. Some things that we look at from an AgDirect standpoint too is what is causing some of the immense growth that we've seen. A lot of it is due to low rate environment. These are some rates that we've seen as low as they've been in the last 10 plus years. So it makes it easier to conserve working capital and borrow that money to update that equipment, knowing that you're potentially not paying as much interest on that equipment. Also strengthening net farm incomes, bigger bushels that we've seen with increases in technology and the way we plant and farming practices, to different subsidy payments that we've seen over the last 12 to 24 months, strong real estate equity positions. We've seen a lot of this come on strong in the last 3 to 5 years, and it's helped a lot of our producers in a good way. And just recently, we've seen stronger grain commodity market prices. Unfortunately, the livestock producers are not capitalizing on as much of this as what some of our row crop guys are. But again, it helps the industry as a whole. And then we look at availability. The dealer, auction, and private party avenues that AgDirect covers. We've seen a lot of growth, namely in the auction and private party areas. And I attribute a lot of this to kind of like the car dealership effect of the last 5 to 7 years. The internet has really flattened, made the playing field a lot more level. So you have access to a lot more information as a buyer, makes it easier to educate yourself. So when you do walk into that dealership, you potentially already know a lot about the piece of equipment that you're looking at. And same thing on the auction or the private party side. So from an availability standpoint in the present day, good used iron is really hard to find. New iron is next to impossible to find. So, you might need to check some expectations at the door. You're going to probably pay on average 10 to 15% more for that same piece of equipment today versus 6 to 8 or even 12 months ago. So utilize those resources. Don't be afraid to look at other channels. And we've got a lot of resources on agdirect.com. We've got a learning center with some resources out there to help educate you on different ways you can approach, say, an auction purchase or a private party purchase, as these are major avenues for equipment buyers as well as sellers. And then number 5 there, the technology and machine availability piece. So this is something that I think is going to continue to become more and more of a priority, and also something that you can't overlook. As the times continue to change, we embrace more and more technology, especially with the way farming practices continue to evolve. You've got to continually be willing to embrace new advances in practices. And it's probably played more of a deciding factor in what types of equipment or machinery you're going to purchase now versus what it had been and even 5 years ago. So much of what we see bolted onto machines, that are 5, 7, 10 years old, it's largely outdated and obsolete. So a lot of times there's very little parts availability or dealerships that are willing to support that older technology on those machines. So you need to continually look at, hey, is that a fit for my operation? Do I need to continue to be looking at new technology? And then on the machine availability piece, I equate this to, is the machine in the yard and is it ready to go? So the percentage of this time that the machine's ready and available to utilize, basically if you got an aging fleet, you don't have a very good maintenance program, you're going to see availability percentages begin to slip. And obviously your expenses to repair those machines are going to continue to go up. And also you're going to have some costly downtime in the form of not being able to put the seed in the ground or take the crop off when you need to. So this is also a key component in keeping fleets, newer, under warranty, and with up-to-date technology. So many producers find that it's a lot easier to accurately depict downtime when you've got machines that are under warranty with less hours on them. You're almost able to fix that expense when it comes to maintaining your fleets. And we'll move on to another 5 factors when we just look at whether you should lease versus own. So this is something that's, I think, varies from producer to producer, accountant to accountant, banker to banker, right? So just some simple high-level overview, 5 factors that we kind of discuss a little bit amongst the AgDirect world and also the equipment guys is, an approach to cash flow management. Leasing can help producers enter the marketplace when machinery costs continue to rise. Oftentimes what a lease will help you do is conserve working capital, which oftentimes, you would be utilizing that capital to purchase machinery or equipment. So leasing also enables you to usually have a lower payment, more of a fixed cost, not just from a payment perspective, but also from a warranty and maintenance cost as well. You have an understanding that for 3 to 5 years, I know exactly what my costs on this machine should be, and that should help you project some of that cash flow, over the next in the near term and the short term, 3 to 5 years. And secondly, like I talked a little bit about, is maintenance and repairs. An aging fleet usually has an increased repair cost. So leasing can help you fix those costs and alleviate some of that by keeping the machine or the fleet updated. And then third, we look at depreciation. So consider some factors such as, decline in asset value over time. Is this a favorable strategy over a 5-year period of ownership? Those are discussions you have to have within your own operation or with, the folks that take care of you from a financial aspect, like your accountant or your lender. So this can also be difficult to predict versus, largely the greatest cost of depreciation that we see in newer equipment is from basically new to about 3 years of age. So sometimes buying equipment that's, 3 to 5 years old, you won't see as great of a hit on the depreciation cost. And then technology. So leasing provides access to a lot of newer technology in the marketplace. It doesn't always demand or, you don't always see the highest economic return on investment, but it might net you a considerable time and cost savings. When certain times of the year, this is of significant importance or strategic value to your operation. If, you can cut your harvest window down from 3 weeks to 2.5, that you have to weigh those options and see what kind of value that is to your operation. And then lastly, from a tax implication standpoint, many producers that choose to lease equipment, they can take advantage of substantial savings, with tax codes like Section 179 from different tax perspectives. 2 of the most popular types of leases that we see are what's called a true tax lease and a conditional sales lease. And with a true tax lease, you can deduct your full lease rental payment as an operating expense rather than depreciate that asset. And then with a conditional sales lease, you deduct depreciation and interest, much like you would with a loan, while you still have the benefit of a lower lease payment. So there's a lot to consider when you talk leasing versus owning, but running some of those different analysis and understanding what's important in your operation and some of the risks that you're willing to take on A balance of both is something that a lot of producers have adopted, especially with some of their major larger ticket items. Whereas like a combine, for example, it's tough to justify owning a brand new combine every 2 to 3 years. So entering into a lease can help you stay current with newer equipment, newer technology, an asset with less hours, and arguably a much better machine availability when it comes to uptime when you need that machine. So a lot to think about. That's pretty much all that I had, but I just wanted to kind of get down and dirty on some of that overview. And we definitely, I know Sonia and I would welcome any questions that you guys have at this time or in the chat.
Yeah, thanks, guys. Looks like there's a couple questions coming in. I have one here that has asking about supply shortages, especially when it comes to used equipment and kind of what's going on, maybe especially this summer. I don't know who wants to take on that one.
Yeah, I can take that one. It is definitely a shortage in the marketplace. I don't know what kind of machinery that you're looking for, but some of we call them, big 4, big 5 assets, tractors, combines, sprayers, planters, things like that. The late model, low houred, good condition, used iron out there is very, very hard to find right now. And it's pulling a premium. And a lot of times what you'd see, in the past would be many producers would take that 6-8 hour drive to come look at that piece of equipment. And now they'll buy it sight unseen. And I know there's a lot of dealers that are trying to jockey for good late model used equipment, and for those guys that have that types of equipment in their fleets, they're able to pull a premium. But one of the issues that they're facing also is I can't trade this piece of equipment until I can get a new piece on the ground, and that's also been a challenge as well. So I don't think we're out of this yet. I would think in the next 12 to 18 months, we're going to continue to experience some of those shortages of the used equipment. And namely, that's going to be driven a lot by the inability for some of these major OEMs or manufacturers to produce enough new equipment to actually, kind of catch up to what the demand has been. So I think it's going to be probably another 12 to 18 months where we're going to continue to see some of this cycle of some limited used equipment in the marketplace.
Thanks. Really great stuff there. Another one that came in, what's the biggest mistake you see people making when they're making a large purchase like this? I'd be curious to hear both of your thoughts on that one too, if you have kind of a different perspective on that.
I'll let you take the first stab at it, Sonia.
Oh gosh, Lucas, you really are the expert here when it comes to that. I am more on the lending side. I guess the biggest mistake to make is taking on more debt than you can pay, that you can afford. So taking into consideration the things that Lucas was talking about, sometimes purchasing the most brand new shiny bells and whistles isn't the route to go. Sometimes it is about going to private parties, auctions, looking at some used equipment, and really assessing like how much are you going to really be utilizing that asset. There are going to be repair costs. There are going to be other equipment that you're going to be needing to purchase, and so sometimes it is about sort of getting the site's expectations a little bit lower when it comes to what you're looking at purchasing.
Yeah, I mean, I would add to that. Number one is I think keeping the emotion out of it, right? Look at it from an objective point of view and understand, like my wife and I struggle with this. We go back and forth a lot if we're making I call it a major capital purchase. She calls it getting a new car. We write it down on paper, or I write it down on paper, what the needs are versus the wants. And usually I don't get my way, but at the end of the day, you have to try to understand how it impacts your business, how it impacts, the balance sheet or the bottom line. And then also, is it going to create, additional, I don't want to say work, but additional steps downstream that you're going to have to think about. I used the analogy or the example earlier of, I think, jumping a class of combine, right? So if you went from, say, a class 7 combine to a class 8 combine, and you want to make sure you utilize the capacity of that machine, Does that mean that you're going to now need to run 2 grain carts and go from 2 trucks, 1,000 bushels a piece, to 4 trucks, 1,000 bushels a piece? And that means you just added an additional grain cart operator, potentially another tractor and a grain cart, and 2 more trucks with 2 more drivers. So you're looking at maybe $1 million in equipment and people just by adding an additional size of a combine. So a lot of things to think about there. But I would just say the 2 factors that I probably see people make the biggest mistakes on is acting on emotion and probably not understanding or making a well-informed decision before they go and decide to go that direction.
Yeah, great. I think once we all learn how to take emotion out of decision making, that'll help everyone, right? I think lots of applications for that. Another question came through. I don't know how much you're comfortable speculating on this, but you mentioned the low rate environment. How long do you see that lasting, or what do you think we can expect? Any thoughts on that? I know that's a big question.
I don't have my crystal ball today, but I think Sonia does. So now
I was just going to say, I don't have a crystal ball. I have seen that it stayed pretty steady for a while here. Recently, we did have a jump. It is just so hard to predict.
Yeah, I think the Fed is committed to somewhere around keeping inflation under 2%. We've seen that kind of tick up here, and I would call it the shorter than short term, last 3 to 6 months. You can see it at the pump. You can see it, with some of the input costs you guys probably see as a producer, seed, chemical, fertilizer, feed costs, things like that. They start to tick up, as long as we keep that in check, and the economy keeps rolling, you can't really push interest rates any lower than what they are right now. So you might see them tick up, between 100 basis points in the next 12 months, but still that's pretty low historically. So I think we're going to be in a pretty favorable environment for 12 to 24 months yet.
Great. Well, thanks for indulging us even without having your crystal ball present. Maybe related to kind of the challenge question, but kind of what are the, I guess, opportunities, especially for kind of young and beginning producers that maybe they can jump on, or, some resources that may not know about? I did drop that link in there, Lucas. You mentioned the Learning Center on the AgDirect website, so be sure to check that out. But any tips in terms of kind of how young people can kind of seize some of those opportunities as they arise?
I think with, and I don't know the general age range of the audience, but, as we see this different generation of producer enter the marketplace, I talked a little bit about, some of that brand loyalty, but a lot of these younger producers have a little different risk tolerance, and they have a little bit different appetite for, I would say, education and understanding the why of what they're doing. And I think with the internet and some of these, there's a ton of forums out there. Some of you producers are probably on Ag Talk. You can get some real-time testimonials, different accounts of whether it's machinery and equipment, it's lenders, it's what brands of seed, fertilizer, what was your experience using, FBN, Farmers Business Network, those types of things. So you get a lot of kind of unbiased data out there that helps you make a better informed decision. And I think that some of those things to consider can only help you as you move forward and making decisions.
But I think I'd like to ask, to kind of wrap us up a little bit, if there's kind of one piece of advice. I know you've already given us a lot of tidbits here, but if there's kind of one big takeaway that you want to leave the audience with before we log off here, what would that be?
For me, I would say do your research. On the application part of it, especially on your credit side, know what kind of outstanding debt you might have. Know what your credit kind of looks like to go into the application process. Have those market-based balance sheets, have those financials ready, proof of payments, that kind of thing. Have that ready before you apply.
Yeah, I think it kind of parallels what Sonia said, especially when it comes to the buying process for machinery and equipment, or much of anything, on your operation is be informed, have an understanding of the factors that negatively or positively impact the operation, whether that's adding that additional machine, or taking a taking a leap and changing your farming practices around a little bit, and how that change or that decision to do so increases or decreases your risk. And I like to look at things from a most likely or most probable outcome to, hey, what happens if I add this piece of equipment and I'm not able to harvest my crop, and we have a significant weather event. Basically worst case scenario, how does that impact us? What do we look like on paper? What does that do to the operation? And I think if you can have a good understanding of those best practices, worst case scenarios, I don't want to say doomsday, but some of those things could happen. What happens if rates do double or triple in the next 24 months? What is that going to look like from all aspects of the operation? If you can better prepare yourself for that and surround yourself with a team of folks, professionals that, have some of those tools and resources to help you, even if that's takes a little bit more time and obviously is a little bit more of a burden to what you want to do, or as a producer, what you're good at, having that team around you is very, very important and will set you up for success long term.
I think that's a great note to wrap up on. I know no one likes thinking about the worst case scenario, but I think in terms of a planning perspective, it's really helpful to kind of keep things in check and, always be prepared for whatever may happen. So we're just about at our time here. So again, I want to thank Sonia and Lucas so much for taking time out of their day and joining us, providing their insights and expertise. And thank you in the audience for tuning in and for your great questions. And we hope you'll join us. We'll be back next month on August 4th. I dropped the link if you'd like to go ahead and register for that one. We hope you'll join us on August 4th. Until then, take good care, and we hope to see you online soon.